So as I mentioned, it's about a company, a food delivery company like Uber Eats and uh, Pick Me. So the ownership structure, you all know that who are the owners, and two subsidiary companies and their business line also be mentioned. So I'm not going to detail on the activities of the company, or they are talking about the processes involved and the risk faced by the company and the strategies they have taken. Those are just qualitative stuff. You can read it out to understand. Okay, so now straight away we go to discuss onto the financial analysis, because actually when I do the pre-scene discussion, I divide into four parts. One is the background. That is where we talk about the structure, industry, who are the owners, right? What kind of diversification the company has done. All that will be in your background. So here we have just touched upon all that. Then we move on to the what you call the strengths and weaknesses and opportunities and threats of the company or the group. So where if you want to look at it, some more information on the strengths, weakness stuff. If you want to discuss, what are strengths you all think the company or the group has? Quickly, you all can type. What are strengths?
Yes, camera on.
Profitable, profitable company. Yeah. Okay. Before that, qualitatively, what are strengths the company has? Yeah, I think they are the first company mobile app platform who created this business 2012. And then the founders are management and technologically sound people. So those are pluses. And they started with very few employees. Now they have almost 80 odd employees. So that shows that they have grown faster, and they have got very good governance structure. Good governance structure being a listed company. Four directors, executive, and four directors are non-executive directors, and one chairman, right? So basically, that shows that they have complied with the listing requirements of the stock exchange. So those are governance aspects of it. But then that's a good part of the company, because then you are more structured, and they have a outsourced internal audit division or international function. So that shows that company has been giving importance for internal control system of the company to be looked after. And then they talk about the certain committees, subcommittees, audit committee, nomination committees, remuneration committees. So that shows that company have independence, involvement in the operational aspect and some audit function. So these just to show that certain strengths. And then in terms of IT, they have done a lot of improvements, and they are continuously giving importance to that side. So that those are the pluses if you can look at it. Apart from that, market leadership, what somebody mentioned earlier, and they don't talk about any competition and that stuff. But then we know that they have started at the beginning, so they have the advantage of the market position. Then in terms of weaknesses, if you really look at, I think not the risk. Actually, risks are not the weaknesses. They have given you a lot of risk, and the strategies they have taken. That is the risk of the industry per se, not only this company. Right? Any company in industry faces those risks. So the whatever strategy you are taking to minimize the risk is also mentioned there. So weaknesses point of view, what weaknesses you have identified? I think one weakness you could look at. They say the directors, the two director brothers, feel that each and every decision they have to be involved in this company. So that is something another weakness, because practically speaking, you can't be involved in every decision making, because that may disturb your business operations also. And being a kind of a food delivery company, you may have to make certain decisions so fast. Okay. Sometimes you have to deal with the restaurants, customers, all that. When you're going to deal, there are a lot of decisions you have to make. So the decisions needs to be made at different levels. So you need to pass on the decision making powers or the authority levels to different structure levels. It's not at the kind of a executive director level. Each and everything has to be decided upon. So that is something just to get an idea what kind of problem this company could face, right? Then Anything else? What are the weaknesses if anyone has identified?
So high finance cost, that is finance leverage.
Sorry, I didn't get you.
High finance cost in the financial statement.
Yeah. In your financial side, we'll come. Before that, I'm just looking at the, because anyway, when you are doing a case study, first understand the non-financial aspect. As I said, when you analyze the case to understand the qualitative side of it, then we move to financial. That anyway we look at it, but don't give higher weightage on the financial only. Look at the non-financial because that will help you. I will explain you later. So this company, are they diversified in your understanding?
So geographical limitation that restricted to Colombo district only
Very good,
for
very
this.
good. I think that's important. So that's very important because they say like even though they have a market kind of leadership, they can't move out of Colombo because there are no much demand in that area, right? There's a fraud reported. Of course, it's a problem, but then that's more relevant to a auditing subject than a financial management subject. Okay, so you can take it into that consideration. Anything else? Any weaknesses you identify?
So limited the strategic diversification. That means
Exactly. That's why I asked the
focused in,
question
yeah.
whether they are diversified enough or not, right? Type it because otherwise there will be voice crashing comes. So diversification, are they diversified enough in your sense? Because they are into the food delivery, fast food delivery company. To support that business, they have two subject company. One is doing IT related support. The other one is actually on the drivers. Drivers are needed to deliver the food. So they are having a driver business. That both are also part of your business, but you have kept it as two companies. So when you look at it, whether you are diversified, no, right? Healthier food concern, as yeah, that's the thing. Now, diversification point of view, if you look at the business as a whole thing, they are not diversified significantly. They are actually into one for fast food delivery business. Other than that, you need to understand whether this industry has a market in the future or not. So, what is understanding? Whether that this business has future. In Sri Lankan context, I would say this is now only starting up. So you are getting definitely a demand. So there are people moving to this kind of business model, or maybe the people like to order goods through the mobile app and get the goods. True that it's not the healthy food we are talking about. It's not about organic food. It's about the fast food delivery. So definitely it has its own minuses. But then this business is growing, right? They believe that business at peak is actually they understand their capacity. Their capacity point of view, yeah, they have already achieved the capacity. But then in terms of the industry, if you look at it, industry is competitive industry, but it doesn't have a huge market space at the moment because out of Colombo, people are not that interested to get goods on this basis. Only thing, it may be a trend which has to slowly move to the other areas also. So we can't say that this won't grow in the future. It's a growing industry, of course, right? It's a growing industry because it's a pattern of your lifestyle, right? Pattern of your lifestyle and why people want to order goods and eat because people don't cook. Now people move to buying goods over ordering. Why it's happening? So that's why somewhere they mentioned one is the people give value for the time, right? People don't want to, spend time in cooking, or people don't want to go and sit at a restaurant and spend time there. So people want to make the time saving one. Then the technological advancements. Definitely, the technological advancements has benefited them, right? So that is the reasons. Technology advancements, uh, people time saving or time minimization of spending on the restaurants or cooking. So that kind of thing has benefited. Then you will see definitely convenience. There are convenience matters because you order, you don't really have to go through the hassle of going to a restaurant, waiting for some time, and then you spend time for the food to deliver. All that is not there. Here it's a matter of while you are going from your office, you can order When you reach home, your goods are at foods are at your home. So those are the advantage of this kind of businesses. We have a negative, that is we are talked about food is not healthier, it's a fast food chain we are talking. True that. That's the one negative side of it. But then other uh, benefit of this kind of businesses in the future, people can still move on, because when the people realize that their time they spend on cooking, or maybe the time spent on the going to a restaurant is sometimes not worth it, then the people move to this kind of businesses. People will order through the app. I think in Singapore and all, like even 20 years back, a lot of people work and then go to the food courts, right? At that time, it was not the food delivery system; it was a food court system. Even 20 years later, before, people go to the food court and eat. Why? They don't want to go home and cook. One is their tiredness. The other time is their time they spend on that. The third thing, it's not so much cheaper, right? It's by cooking home. Maybe in Sri Lanka, we are not into that level, right? We are now only picking up, then now only the trend is coming, the younger generation moving to more cafes, more street food habits, or that kind of thing. With this upcoming mobile app ordering, people working late, people order and eat, and then even at home, then they get together when they watch cricket matches. So this is the kind of trend happening nowadays. So this is the industry which will grow to some extent for longer period, and then maybe come to a saturation where it will get stopped. But from the diversification point of view, true that it's not diversified. You are into one business line. So maybe the company needs to look at the risk of dependent on this one business. They need to look at and see whether they want to move into different other businesses. We'll come to that discussion later on also. So that is about the diversification matter. Then when you go to the uh, risk, I told you that people who joined later, the risk they have mentioned two pages actually. What are risks this business is facing? What are strategies they have taken? Please go through that. Why I'm saying is you need to be aware of the risk and the risk management techniques they have adapted already, right? Risk and the risk management techniques, what they adapted. Maybe I did a page number just to give you the idea. The page number page number 4 and the 5 and 6. All three pages, right? So all the 4 and 5 actually mainly are talking about the risk and the strategies they have taken to minimize the risk. So please be aware of the risk this company faces and the risk management what they have done. Since the examiner already given, I don't think they will ask again that question, but then you should be aware of the risk and risk management. Then the directors list has been given. That's all more of a auditing related side, where the independent directors, executive directors, non-executive directors. Now we move on to the financial analysis. Before that, let's just touch upon the drivers side of the business. The company which is QEP, that's actually they're talking about the drivers are what? They have Quick Eats Riders Private Limited, the company called that. So they are talking about that company have permanent drivers and the contractual drivers. So permanent drivers are the employees of the company. Contractual drivers are the ones who are on their free time. They can deliver goods on behalf of the company and they get a commission. So that's another set of employees, or not employees. They are people who are delivering goods for company. Then we move on to the, I think there's somebody mentioned about cyber attacks. Yeah, that's the issue that the company has faced already, cyber attack. Okay, so the IT dependency is very important for this company. So you are dependent purely on IT. So if the IT doesn't work or system doesn't work properly, your business model doesn't work or it fails. That's what they have mentioned somewhere. They have already had one experience where 2 to 3 hours downtime, where the system has been down. So that's a problem. So please understand that when the downtime happens, your business doesn't work. People can't order goods online. And that will be a problem because the restaurants also will realize if a couple of times it happens on a week or 2 weeks time, the restaurants will basically will terminate your relationship. So you need to know that the risk what they face is that system dependency is there. They have to make sure the system is properly working, and they should update the system properly and make it more user convenient or a convenient purpose, user friendly. These things have to be looked after. That anyway, they have one company to look after these things. But what you need to be aware of it is very, very important aspect of this business is IT side of it. Okay. So now we come to the financials. So you are given 2 years P&L and balance sheet, company and the group. And company, when we say it's the parent company, which is mainly the food delivery company. And when you take the group, you have the business of IT company as well as your parent company and the delivery whatever drivers company. But you should know that any services provided by the two subsidiary company to the parent, what happens? Anyone? In terms of accounts, the two subsidiaries are 100% owned by the parent. If the two subsidiaries are providing service, the driver service is provided to parent company and your IT service is provided to parent company. So how that will be counted in your accounts, group accounts? Anyone? Very good. Exactly. It's omitted. It's an intercompany transaction. So your revenue and expenses would be eliminated in the consolidation level, because definitely your subsidiary company will be providing the IT services, that is mobile app services. For that, they must be charging. The IT company has a revenue income or the income, and the parent company has expense, IT expenses. At the same time, you will see the drivers cost would be charged to the parent company. So parent company has drivers expenses in their P&L, and the rider company, that's the riding company. That company will have income, but when it comes to consolidation, both get eliminated. It's 100% company, so no minority interest involvement. So that is the case. But then if you look at the P&L revenue, your 2024 revenue is 2.4 billion. 2.4 billion become how much? Group point of view. Anyone? 2.4, 2.9. That 500 million income, additional income of 500 million comes from where?
Subsidiary.
Y'all, I think y'all believe the consolidation understand. 500 million increase in the revenue. So what could be that? Anyone? Exactly. Very good. Because they have mentioned they do certain work, the IT company especially, do work for outside companies, outsiders. So they provide services to outsiders also, right? Services to other companies. That is in a page number 8 under Quick Eats IT Private Limited, last line of that paragraph. The company provides IT services to other companies. So definitely the other company's revenue is also included in your total revenue. So we believe for time being, the 500 million could be coming from the IT company services which are provided to outsiders. Because if you it's an internal service provider, it get eliminated. So your company and group should be having the same revenue. But since you are providing service to outsiders, your revenue is more than your company. Okay. So then coming to the P&L, we first look at the P&L of the company, 2 years. When we look at the ratio analysis, because then when you do the financial analysis, we use main tool as the ratio analysis. When you do the ratio analysis, firstly, the ratios needs to be calculated under 4 headings. That's my general guideline. 4 headings. What are 4 headings? One is the profitability area. Second is the liquidity area. Third is the gearing side of it. Fourth, shareholder returns. So there are 4 topics or subheadings. You can take it. Under that, you calculate relevant ratio. One is the profitability. Second, liquidity. Third one is your gearing. Fourth one is shareholder return. So when you look at the profitability point of view, where do you start? Profitability, you can calculate many ratios. Okay, so at least we'll limit it to say 4 ratios. GP margin. Okay, so GP margin, I'm sure like all of you all know that you can calculate GP margin for the company, comparing current year and the last year. So GP margin is 1. Then your operating profit margin, GP margin, then operating profit margin, then return on capital employed, and net profit margin. So these are 4 ratios you can calculate. I'm sure all of you all would have done that calculation. So if anyone has not calculated, you have to calculate the GP margin of the company. Can I have the numbers? Can anyone share the numbers? GP margin 2023, 2024. Those who have calculated already, I'm sure would have done it by now. GP margin 23 how much? 24 how much? 58.60 exactly, right? 23.58, or is it 24.58 and 60 is the 23.55? I know. I think you all understand what is GP margin is, right? GP margin is, how do you calculate? 23.24 GP margin. I think your 23 GP margin is 55. 24 GP margin is how much? 58. 55 and 58. I don't know why the people are making mistake in GP margin. It is a very simple calculation. Gross profit divided by revenue. Yeah. 58 and 55. Not 60. I don't know why do you take 60. 55, 58. That's a company we are talking, not a group. Company. Okay, so that's the GP margin. No, I'm not talking about group. I initially mentioned we are only looking at the company first, because parent company is your main company. Right? Out of 2.9 billion revenue, 2.4 comes from your parent company. So that is your main business. Right? The other one is your subsidiary company providing services to outside parties. That includes in your group revenue. So we are more concerned about the company performance, right? Because the company is the key. So I think somebody managed GP divided sales into 100. Yeah, that's calculation. Okay, thank you very much. So your GP margin has what happened? 55 has become 58. So it has improved compared to last year. That's fine. Then operating profit margin. So what do you do? Profit from operating activity divided by sales. Profit from operations. Okay, 36%, 23, and current year 35. Okay, so it has reduced compared to 23. The operating profit margin as 36. I don't know, still people are making mistakes. Basic calculation. Operating profit margin is operating profit divided by sales of the company. We are not talking about group. I repeat, company. Company operating profit is how much? 841 divided by 2,400. 841 divided by 2,400 is how much? It's 35%. 24, 35, 23, 36. 24, 35, and 23, 36. If you really look at your decimals, it's 36. Okay, so that's your operating profit margin. So basically what had happened? GP margin has gone up slightly. Operating profit margin slightly dropped. Okay. Now you need to know why the net profit margin has come down. Not net profit, operating profit margin has come down by 1%. Even though GP margin has gone up, but your operating profit margin has come down. Why? Anyone?
Expenses has increased.
Yeah. So you need to know, generally, if you are looking at your sales is growing by a percentage, there is a categories of expenses which will go up or go with the sales. What expenses go with the sales? Selling and marketing has to go with the sales. So if you are talking about how sales is going up by what percentage? Your sales growth how much? Your sales growth is how much? 27%. Now your sales and marketing expenses have gone up by how much? Sales and marketing. Yeah, 38%. So sales and marketing gone up by 38, whereas your sales have gone up by 27. So you can understand that your sales and marketing expenses have gone up more than your sales gone up. So maybe you would have done more promotions, more discounts, because in order to attract more customers by the mobile app ordering, where there are competition happening in the market. So you might be giving the customer benefit of getting some discount offers so that people order through you. Maybe the food, the restaurant price will be the same, but you will be the app company, this is a delivery company, try to attract more customers by giving some discounts from their income what they get from the restaurants. So therefore, you should know that those expenses have gone up. That is why 38% increase in the sales expenses compared to your revenue expenses. Revenue gone up by only 27%. Then the admin expenses. Admin expenses gone up from 110 to 200. So 110 to 200 means almost 100% growth. So the 100% growth, that is in admin expenses. So that you should know that what kind of admin expenses, because their staffs have gone up. So they may be paying IT related costs. That can be your admin expenses, or the management staff cost would have gone up. We don't know the detail of these costs, but then definitely it has gone up significantly. So admin cost. Generally, admin costs are fixed cost. It's not a variable cost. But your variable cost has not gone up very much, in the sense like your admin expenses is fixed cost. Fixed cost gone up by 100% is not a very good sign. Very good sign, because even if the sales drop, your admin cost has to be borne by your company. So we don't know at this moment what kind of expense they include in admin, but definitely it includes mainly salaries, your premises cost, your, if you are paying a rent or something, you have to pay that. That kind of that could be in the admin cost. Okay. So that's another concern area. Then we come to the return on capital employed. Return on capital employed. More than the first two ratios, I would be more giving importance to the return on capital employed. How do you calculate return on capital employed? It is operating profit or EBIT. EBIT means earning before interest tax. Operating profit, which already we use for operating profit margin, that divided by your equity plus debt. Equity plus debt. Equity, if you look at the return on capital employed, you can calculate in multiple ways. One way is that equity plus debt, or you can take the total assets minus current liability. So I would generally recommend you take the return on capital employed by taking operating profit or EBIT divided by equity plus debt. Equity plus debt. When I say debt, it's the interest bearing borrowing, long term and short term. Interest bearing borrowing, long term and short term. So can we have the number, please? Anyone? Operating profit. It's again company we are talking about. Operating profit divided by equity plus debt. Debt includes interest bearing borrowing of short term and long term. Yeah, thank you very much. Somebody has done the calculation. It's a 6% and 5%. Very good. 6 and 5. So your return on capital employed. Please make a note of this number. This is more important ratio in this whole case. Return on capital employed. Please make a note of this ratio. GP margin, net profit margin are not that so important from my point of view. But the return on capital employed very important. So can you write separately and keep? How we calculated operating profit, that is EBIT, divided by equity plus debt. So you have got 2024 6%, 23 5%. I believe that numbers are correct. So keep that in mind. We'll come to that discussion later. So you know that that is your return you are getting. Then you can calculate net profit margin also. That is again net profit divided by your sales. That's again just a ratio you can calculate. Now, when you look at this overall profitability ratios, can you conclude in one sentence whether this company is generating sufficient return in terms of profitability or not? Can anyone answer? But can you chat it? We calculate GP margin, net profit margin, and we calculated return on capital employed. Can everybody answer this, please? Because this is what the needed, not the number calculation only. Number calculation, you can do it anyway. EPS, no. EPS also can use it, but that's more of a shareholder's perspective. So in the sense like shareholder investors returns, we don't generally call it. So can I have the answer whether that company is earning sufficient profit for the shareholders? Margins are okay. What do you mean by margins are okay? Your 6% return, you are getting return on capital employed. What do you mean by return on capital employed? Please understand that ratio properly. Return on capital employed means your company has been invested by shareholder and debt holders. Shareholders and debt holders. So shareholders and debt holders wants to have a return. They are expecting a return. And shareholder, debt holders invested in the company expecting a return, and you are generating through the profits. So your profits for the EBIT, that operating profit, compared to the shareholder debt holders money, you have generated 6%. Now today's context, we are in Sri Lanka, today's context, 2024, what is your bank interest rate? What is your bank interest rate, right? If you really look at practically, bank interest rate is 8%, 9% level. The question gives you some information in page number 9. Page number 9. Interest rate of long-term government bond. That's a treasury bond. How much rate? Page number 9. Exactly. So if you are going to invest in a long-term bond, as an investor, you get 11%. And you are investing in this company called QPE. So if you take the government bond is giving you 11% and QPE business is generating 6% return for the investors. Is it sufficient? Can we conclude that? Exactly. The answer is no. Even the risk-free return, you know the difference between risk-free return and a risky business return. So businesses are risky. Risk-free return is 11%. And risky business where you are investing a shareholder or debt holder, you are giving money, do you expect more than 11% or less than 11%? Can anyone answer? More than 11%. Of course, you want more than 11%. How much you are generating for investors? 6%. Is it sufficient? Not sufficient. Yeah. So can we conclude the first ratio category called profitability ratio? We are concluding the company is not generating sufficient return for shareholders and debt holders, right? Company is not generating return for debt holders and shareholders. So can we conclude that? That's your profitability ratio calculation. Company is not generating sufficient return for debt holders and shareholders. That is one. Then we move on to, we'll come to that discussion again later. First of all, we conclude debt holders, shareholders returns are not sufficiently earned. Company not generating. Then we come to the liquidity. Can we get the liquidity ratio for company faster? Generally, we take two ratios mainly, current ratio and quick ratio. Can I have the current ratio of the company for 24 and 23? Current ratio. Current assets to current liability. Where can I find the document from? What document? I need a pre-seen document. I am sure all of you are having the pre-seen document, right? Yeah, your current ratio is 5.2, 23, 24, sorry, 24, 5.23, and 23, 6.3. So basically your current ratio is very high. Quick ratio, you remove the inventory, but in this company, no inventory. Very, very hardly, basically nothing, right? You're saying from CA Web. That's great. Okay, right. So we are talking about current ratio 5.2, 6.3 compared to quick ratio, which is all the same because there is no inventory here. So quick ratio and current ratio is almost the same. Now, what we need to understand here, your current ratio is very high, very high. Generally, what is the guideline? To meet your current liability, how much current assets you should have? Exactly, 2:1. General guideline, not 1:1, 2:1. Somebody say 1:2. Okay, students, I think you all have to get your basics right. Current ratio, general guideline is 2:1, right? 2:1. So that means to pay 1 rupee of your current liability, the company should be having current assets at least 2 rupees, at least 2 rupees. So you should have current assets of 2 rupees to pay 1 rupee of liability. So in that case, in this company, you have almost 5 or 6 rupees per liability, 1 rupee. So you have enough current assets. So is it good or bad? Having enough liquidity is a good or bad? When you have more liquidity, it looks like you don't have any liquidity problem. But you have a problem, excess liquidity. Excess liquidity means what? Your excess monies are not earning anything. Generally, short-term assets may not be earning much. So you are losing the profitability, right? Using the profitability. It's a overcapitalized, in that sense, overcapitalized. You are gone and more capitalized in your current assets. So you would see that. Can you now take your balance sheet? Can you look at your balance sheet? You could see that under current assets, out of your 7 billion current assets, 3.7 is what? Out of your current assets 7 billion, 3.7 billion is what? Exactly. It's in your other financial assets. So maybe you would have invested in reverse repo or short-term money market instruments. You would have invested in short-term investment. Maybe they are generating some return, but it's not sufficient. Why? These are short-term. You should have a basic idea that long-term investment generate higher return than the short-term. That's the your normal slope curve. That's under interest rate risk management. You would have studied your yield curve. It's a upward sloping curve. So the shorter period give you a lower return, longer period give you a higher return. So in this case, if you have gone and put the money into other financial assets and the current assets, that means you have invested short-term investments. Short-term investment will be generating a lower return. So it may not be enough. It not be enough, right? So out of your profitability concern, what we talked about previously, we know that this company is not generating sufficient return for the shareholder and debt holder both. Why is that? Now we can understand better than the initial discussion. The company has kept more money where? In your assets, other financial assets, which are not generating sufficient return, So you need to now sit and look at what can I do with these other financial assets or the excess money, because you have cash and cash equivalents of 1.2 billion. So at least cash and cash equivalent, we don't know whether it's a bank balance or the book balance only. But other financial assets, we are sure that it is in your short-term instrument, which are generally generates lower return than the long-term investment. So the problem is your company is not generating sufficient return. Why? You have put your money, some of the money, in the current assets. So you need to first find out what can I do with this excess money? What can I do with the excess money? I think if you read the case properly, there is one place they mentioned they have identified the value creating opportunities have to be identified, and they already identified 2 investment opportunities. What are 2 investment opportunities? Anyone? No one is answering. This company identified, exactly. One is the restaurant chain, other one is exactly possible acquisition. Thank you very much. So you know that there are 2 investment opportunities. We'll come to that discussion a little later. So you are identified. So that is why the company also understood they have excess money. That's not generating sufficient return. That is why the returns are lower. So it's not good for the company. So please understand that at the moment, company is not generating sufficient return. Why? They have excess money kept in the current assets. When you make a note somewhere, your excess monies are kept in current assets, which are mainly short term. So they don't generate sufficient return. So you need to reallocate your money to a long-term investment to create more return, to create or earn more return for investors. So that has to be you have to make a note of it. Then general question, if you are looking at your liquidity, you have excess liquidity. Is it a problem or a good thing? We answered earlier, it's a problem. Why? You don't need such a huge liquidity. So you have to take out your money from the current assets and put it into long-term investment. Maybe it's acquisition or maybe a long-term investment yielding return in yielding investment. So that's about liquidity. So now we have done two ratio analysis. One is profitability and liquidity. Profitability, we have understood it's not sufficiently earning for shareholder or debt holder. It's a problem. Liquidity, we have understood it's you have excess liquidity, so we have to correct that also. Now, third one, we look at a gearing. Can we calculate gearing ratio? Debt divided by debt plus equity. Debt is short term and long term. Why we take short term? Only interest bearing borrowings, which are payable within 12 months. We consider it's part of your long term debt capital because it's a long term nature debt. So can we have the calculation? Company, what is your gearing? Can anyone answer? 29 for, is it 29% for both years? Very good. Thank you very much. So 29, is it a lower gearing or higher gearing? It's a low gearing or high gearing? Low gearing. Lower gearing is a good thing or bad thing? Very good. I think you all have better knowledge about capital structure area. Low gearing is a bad idea. Low gearing is not good because you can gear more. Your company is only low gear, so you have still more chance to gear the company. But when you are going to decide on the more gearing or gearing, what is the basic rule? Can anyone say that? Anyone going for gearing or anyone going to increase the gearing? What is the basic rule? What things to be looked at? What is the main thing you look at? Anyone? Whether I should borrow further or not, how do I decide? Exactly.
Required rate of return.
Your return should be more than, and there are a lot of answers coming. No. Simply understand whether I should increase my gearing or not depends on whether you are able to earn return from the investment more than the cost of debt. There are a lot of answers you are giving. I think you all have to get your basic right. Financial management, your debt, you need to be very clear. Simple thing, when you are going for further gearing, first thing you have to look at whether your investment will give you return more than cost of debt. Thank you. Somebody is mentioning at the last, right? Return has to be more than cost of debt. Somebody asked you whether lease liability, come on, we are talking about chartered final level people. Lease liability is how much here? Waste of time talking about it. Yeah, right. These are not relevant. Okay, small amount, 1 million or something. Right? Your gearing, always the gearing question comes. When you come to decide on the gearing, please understand your return on investment from the investment what you're going to make should be more than cost of debt. Not RR should be more than cost of capital. It is the return of investment more than the cost of debt. Cost of debt. Don't just broadly say cost of capital and everything. That will be RRR or return on the investment more than cost of debt. Now we should know what is the return, what is the cost of debt. How much return we got? At the moment, the present business is earning a return of how much? Already we have calculated 6%. Very good. Cost of debt is how much? The examiner doesn't say anywhere the cost of debt. But is there any way that we can at the moment calculate the cost of debt? Anyone can say a cost of debt, effective cost of debt? Exactly, based on finance cost. You divide the finance cost by the interest bearing borrowing. Finance cost divided by interest bearing borrowing. Idea on that. It may not be the exact rate. It may not be the exact rate. Somebody saying 13. I don't know from where you get 13. Finance cost is 800. 800 divided by interest bearing borrowing. How much is that? Roughly 4 billion. Yeah. Don't make mistakes on these things because these are just unnecessary. You are going to lose marks. These are just to understand what is the effectively finance cost is going to be. But maybe the unseen material may give you the further information about your cost of debt. But at this moment, we have to calculate effective cost based on your P&L and balance sheet. So I think roughly it's 19-20%. Now tell me, you have a 19-20% finance cost at the moment, and your debt holders are expecting a return, which is 19-20%. And how much you're earning? Yeah. So can we now more emphasize and tell, are you earning sufficient return for debt holders? No. Very good. So we are clear. So we are not earning return for even debt holders. Forget about shareholders. Debt holders even we are not earning sufficient return. So at the moment, the company is not generating sufficient return for debt holders because you have borrowed at higher rate, and your returns are sufficient. Please note, there is one additional information you should be clear. 2022-23 period, 22-23 period, the interest rates went up very high. 22-23, the interest rate went up very high. So the company which has borrowed during that period would have borrowed at very high rates, very high rates. Maybe if you have taken the loan under floating rate or variable interest rate, now 2024 after March or whatever, you will see your interest rates will fall. But if you talk about 22, 23, 23, 24, even at the beginning periods, your rate will be at higher rates because if you are borrowed at fixed rate, you are at higher rates always. So you should be clear here. Your present effective rate is very high. Present effective rate is very high, which is not at all acceptable today's context. So your interest rate is very high, mean your risk of interest rate is very high. So what is the risk management? Anyone? If your interest rate is high, any risk management? Yeah. You have to do interest rate risk management techniques. One of the technique is interest rate swap. So maybe possible area of questioning in your exam, this also be there, right? Interest rate parity. Interest rate parity and all will be for the foreign currency risk management, not for the interest rate risk management. Good that you all say whatever wrong things in this whole forum so that you know that you are not clear on certain area. So that's good that you have another 20 or whatever days or 17 days to study. Okay, so that's good. You make mistakes, don't worry about making mistakes. That's good for you to understand you are making mistake. Pooling, no, interest rate risk management area, you need to be good to your theory part. But what I'm only guiding you, there is a possibility of this question because your interest rate is at a higher rate at the moment. Maybe you would have borrowed at a higher rate 2 years back and you are at a fixed rate. So you can't reduce your interest rate at the moment. That's a problem. So you have to do a risk management of interest rate. Okay, keep that in mind. But on the other side, your returns are lower than interest rate of the loans you have taken. So it's a problem. Okay. So keep that in mind. So gearing we have understood. So gearing what we have understood, you are at the moment low gearing, but at the moment your company is not earning sufficient return for debt holders. So it's not advisable. It's not advisable to do further borrowing. It's not advisable to do further borrowing until your return you are going to generate from a new investment or new acquisition is more than your cost of debt. If you are able to earn more than your cost of debt, please go and borrow money and invest. Otherwise, don't borrow further because you are not generating sufficient return for debt holder. It's a problem. Maybe today, if you are going to borrow, you are benefited. Why? Your rates are lower now. Central bank has been keep on saying that banks to reduce the rates. Already banks have started reducing, but still some more to be reduced. If the bank rates are going down, you may be borrowing at a lower rate, 10% or whatever, and you can invest at 12, 13%, and you get better return. But at the moment, your company is earning 6%, which is not enough. So we have to address that also, gearing side. Then the last one, your shareholder returns. Can we calculate the return on equity? Can anyone calculate return on equity? That is profit after tax of the company divided by equity. Can we have the number? Profit after tax divided by the profit after tax divided by equity. Can we have the number? Very good. So you are getting a 9% return to shareholders. 9% return to shareholders. So 9% return to shareholders. That is because your EBIT is, even though lower, your shareholder return is better. Anyone say why? Why your shareholders are getting better return than the EBIT return? Or return on capital employed is 6% and return on equity is higher. Why? Can you look at your P&L, please? Thank you. Yeah, thank you very much. Finance income. So finance income has given you some boost by which you have increased your return to shareholder. But overall, your 9% return to shareholder, sufficient, not sufficient? Exactly. If you are the shareholder, in order to invest in the company like this, what is the return you would be expecting? What is the expected return? More than 11? More than 11? I think page number 9 has some more information. Page number 9. Page number 9 information, what you can calculate. Cost of equity, expected return. On what model? CAPM. Very good. So using CAPM, when you calculate how much your expected return or the cost of equity of the shareholders, risk-free rate plus risk premium. Risk premium is 5%. Then your beta is 1.1. When you calculate CAPM use calculation, you are getting 16.5. Now you understand, as a shareholder, right? As a shareholder, what is expecting your return? What's the return you are expecting as a shareholder? 16.5. And how much return you are generating? 9%. Are you satisfying the shareholders? Is it 6% or 9%? We are talking about shareholders. 6% is to both shareholder, debt holder. Now we are talking only about shareholder. Shareholder expects 16.5 but getting 9%. Are you generating sufficient return for shareholder? No. Yeah, very good. I think that basically concludes my ratio part of it. 4 ratios we calculated. First, profitability. Company is not earning sufficient profits. 1. Second, liquidity. Company is over liquid. That means they have excess money. They have not invested properly. No, therefore, they are not generating sufficient return. But excess liquidity. That is too much. We don't need that. Third, gearing. We are low geared company, but the problem is we are not generating sufficient return. So no point in we further borrow and invest in this company. And we have anyway excess money also. So we have to first find the opportunity to invest. Until then, we should not borrow further. Third. Fourth, return on equity is not sufficient. Your shareholders expect 16.5, but we are generating only 9%. So we have to find ways to earn more returns, more investment opportunity. So this is basically we conclude. So keep that in mind. This is the case knowledge on the ratio side of it. Then we move on to calculate the cost of capital side. Cost of equity, we have got 16.5. Cost of debt, how much? We already found based on effective interest calculation. Cost of debt before tax, how much? Cost of debt, 19.5 or whatever. Yeah, 19, 19.5, 20, that range. Okay. So your cost of debt is roughly that. Can we calculate WACC, weighted average cost of capital? How do you calculate weighted average capital? We did the percentage of cost as well as the gearing. So we have already calculated gearing. So based on that, can we calculate WACC? Can anyone calculate the WACC? 15.3. In theory, you learn WACC, you would have learned when you calculate WACC, two things to be remembered. What are two things? Exactly. There are two things to be remembered. One is you need to use the cost of debt after tax. One. Second, your equity and debt proportion has to be market value basis. Market value basis. Can we calculate market value of debt and equity in this question? Always, the most of the time, you will see that debt will not have a market value. They don't give you market value of debt. So we assume simple assumption, debt market value equals to book value. So we don't worry about that. Listed company is your company, therefore definitely you have market value. So you can calculate market value of the company. Can I have the market value of the company for information? How many shares the company has? How many shares company has? $300 million, exactly. So 300 million number of shares and market price is 32 rupees. What is your market capitalization or market value of equity is how much? Market capitalization or market value of equity is how much? Anyone? Exactly. 9.6 billion equity. That's the market capitalization. 924 million. From where do you get the 924 million? 9.6 billion is your equity. Debt, I think roughly it's 5 billion. So you can calculate based on market value, you can calculate your WACC. Book value also you can calculate. Market value you can calculate. But better we use the market value because that's the general guideline. Can get the WACC under market value? $15.3. Okay. So in the 15.3 is based on book value or market value? Okay. WACC. Can anyone confirm that it is 15.3? Students, can anyone confirm whether your WACC book value base is how much? Market value how much? Yeah, you are right. Actually, generally, cost of equity is more than cost of debt because of the financial risk. But here, the 16.5 is cost of equity, cost of debt is 19. That is actually we are using at the pre-scene level because we are not given the information how much the cost of debt. We have just calculated effective calculation. Basically, we take the P&L finance cost against your debt in your balance sheet. So roughly, we got a 19%. As you mentioned, I think I mentioned earlier, 2022-23, the interest rates were very high, very high. So the rates have been very high. So therefore, we would have borrowed at a higher rate. But today's context, the rates have come down. Since you have borrowed at a higher rate, at fixed rate, you may be still borrowing or still paying at higher rate. So that's the problem we have. But for WAC calculator, you don't have to worry about those things. WAC calculator, you take the 19 and 16.5 according to the proportion 36 or whatever, gearing ratio, calculate your WACC. I think it's 15 point how much? Somebody saying book value is 17.4. What is 17.4? Okay, WAC is 17.4. I don't think it's 17.4 comes. Can anyone confirm? It can't take so long. Because your equity, book value and market value of equity is not very different. How much a book value of equity? Can anyone say? Book value of equity how much? Market value of equity how much? Exactly. That's right. Book value 15.4, market value 15.3. Exactly. Because book value of equity is 10.2, market value of equity is 9.6. It's not very different. Okay. So, okay. So the WAC we have got it. So we know the what is the WAC of this company at the moment. But again, I am repeating, WAC is at 15.4 when we are considering interest rate as effective rate of 19%, which may change because present interest rates in the market is lower. So when you get the further information on your unseen, the rate can vary, rate can go down. But present information, we can calculate WCC at 50. So that's in mind. Okay, so that we have got. Then what is relevant? What is relevant? The valuation area. Okay, what is the valuation area? This company is targeting to buy two companies. This company is targeting to buy two companies. There are annexure 3, which gives you the information about the two target companies. One is City Hotel, other one is the Palace of Seafood. There are two company information given. These companies are targeted by your company to acquire the businesses. We'll come to the discussion on that valuation side. Before that, if you take the company and group, is there a significant change in terms of profitability or liquidity or gearing? Do you see a big change? Significant change? Anyone? You can calculate the same ratio what we calculated for group because it's a pre-seen level. Pre-seen level, you have enough time. Another 3 weeks also you have. So you can calculate any number of ratios to understand the case. Not that you are going to write all that. It's only to understand. So if you really look at your P&L and balance sheet, do you see a significant change between P&L balance sheet between company and group? Anyone? Please think always you are a CFO or the finance manager of this company. Don't look at an accountant, assistant accountant level. Why I'm saying that? Because when you look at assistant account like 100 million is a big thing for you. But when you're CFO, when you look at this company picture, 925 million and 1.1 billion, you don't think it's a big change. Okay. But if it's accountant, assistant accountant, you say no, there's a big change. So that's why I'm saying like you have to first consider yourself into finance manager CFO level. Then only you look at the case. Can you confirm whether that group information is so significant comparatively compared to company? Anyone? Out of your total group business, which contribution is higher? Is it the company or subsidiaries? Very good. It's company. So already we have got all the ratios. Same thing you repeat it for group. I'm not taking that time and discussing that. That same thing you can calculate, but that doesn't make a big difference in your understanding of this case. Okay. Now we are going to talk about the acquisition of two targeted company. City Hotel. City Hotel has how many rooms? Exactly. 100 rooms hotel. And do they have fast food restaurant? Yes. So they have that. The other seafood one, seafood. If I put it, seafood also as a restaurant. Yeah, restaurant is their business. But what is the difference between the two companies? Accommodation. Yeah. First one is a hotel plus a restaurant. Second one is only a restaurant. So you should know the difference. And second one is more of a high-end, high quality, expensive. It's a restaurant. It's a fine dining. That means you go and sit and have dinner or lunch or whatever. But the other one is having a fast food also and a hotel chain. Okay, so you should know the difference between the two businesses, what they are talking about. Then the ownership. Ownership. The first one, the hotel, how much ownership is for sale? 70%. Second one, 50%. So you are very clear about the ownership. Now, which business when we buy, when we acquire, we will have more synergies. Yeah, that's hotel company. Why? Because they have already a fast food chain. So we can merge and then we can do the delivery also them. They have a hotel business. We can do the delivery. So there is a synergy benefits more in that than the restaurant. Because the restaurant, what you are talking, the seafood, it's a fine dining restaurant. Fine dining restaurant. Fine dining restaurant means people prefer to come there and sit and have dinner or lunch. That means the experience they like. They pay for that. It's not only the food. So the fast food is a food only. We are not able to experience there. So you should know that there is a big difference between a fast food delivery business and a dining restaurant. So that even though it's all in the similar industry, like you think about fast food and for restaurant, all have food. So food is common in all these. But if you talk about nature of the business, it's different. It's different. And very important, if we buy the restaurant, the synergy benefits are comparatively lower than the hotel business because hotel food has a food delivery also, or they need a food delivery. So there is a synergy benefit. Now tell me, if I join with the CPRH, that's hotel company, what synergy is going to be, or what merger is going to be? What kind of merger it is? Is it horizontal or vertical? What? Exactly. It's going to be a vertical. Now we get all the answers: horizontal, vertical, conglomerate. Those are three types of merger. Now you can tell where you are standing now at the final class or final briefing discussion. All three you answered. I am talking about the hotel company. When you merge or acquire, basically what kind of integration? Is it the horizontal integration or vertical integration? Horizontal mean what? You have to merge with the same industry. If it this company to merge with, what company it should merge? Can you give me an example? If you say it's horizontal integration, what is the company they should be merging? Very good. I didn't pick me. Uber. You merge it, pick me Uber. That's your industry company. So please note that that's your industry company. That is horizontal merger. So here you are not talking about that. You are talking about a restaurant, hotel, restaurant, and you are going to deliver their goods. So it's a backward integration. It's a backward integration or it's a vertical integration. Under vertical integration, it's a backward. It's not forward, it's a backward. Okay. Not a conglomerate. Somebody said conglomerate also. So it's wrong. Then we move on to the second one, Palace Seafood. Right? Palace Seafood, if you are merging, what kind of merger it's going to be? It's going to be conglomerate. Why? It's not your business. It's not fast food delivery. It's a dining restaurant kind of stuff. So you are going to do a conglomerate merger. So please understand, maybe the examiner could ask what kind of merger it is, what synergy you can get. You should be aware of it. So please study your 3 weeks time, study the merger types, understand it properly, see which synergy, which merger you get more synergies. Please have a knowledge on that. Now, again coming back, out of these two hotels or two businesses, which one we will be controlling? Of course, CPRH. Why? We buy 70%. Other one we buy only 50%. And more importantly, balance 50% owned by whom? Chef. Exactly. So whether we will control the business or the chef will control the business. Okay. So you need to, for understanding purpose, please understand we might get 50%. You will get 50%, but then definitely you don't have control of the business. You don't have control of the business. But the first one, you have the control over the business because 70% you can buy. Okay. This is for qualitative stuff I'm talking about. Now we come to your valuation point of view. So if you are going to value these two target companies, first of all, what is the net asset value of the CPRH? They have given you that information. Net assets of the CPRH is how much? 12 billion. And the POS net asset value is how much? POS net asset is 8 billion. Very good. So we know the net asset value 12 billion, 8 billion. So what is the value we are going to take? Net asset basis is the net assets value, 12 and 8. But we know that any company, if you want to know the proper value, what is the basis we should be using? Any company, if you want to know the fair value or reasonable value, which valuation method we should be using? Very good. Free cash flow method. So that is why the information is given for you of two companies, the information to calculate free cash flow. So I'm sure, like, based on your previous past paper questions, if you have gone through it properly, the videos, you would have known that it's always the free cash flow based valuation. So free cash flow, there are two types of free cash flow. One is free cash flow firm, other one is free cash flow equity. And most of the time, almost all the papers in the past had tested free cash flow firm. So free cash flow firm mean, is it before financing cash flows or after financing cash flows? Yeah, it's before. So here, if you take your table, page number 14, last page, if you take your table, both target company, they have given you earning before interest tax, then additional capital expenditure, depreciation, changes in working capital. So in order to calculate free cash to firm, we generally start with EBIT. Then we deduct the taxation. Then we add back to your depreciation. Then we minus capital expenditure and working capital. Then you get the cash flow, free cash flows to firm. That free cash to firm, your discount. Now, what is the cost of capital we should use for free cash to firm? Now the number. Very good. Free cash to firm, you have to be discounted using WACC. So what is the WACC? Yeah, 15.3. So should we calculate value of the target company? Should we calculate the WACC, target company value, by discounting the free cash to firm by 15.3 or not? No. Why? Exactly. It's not a capital structure is going to change. Capital structure is going to change. There's somebody saying including hotel industry. Yeah, leave the operational risk aspect. Capital structure change can happen, may not happen. That we can think about it because the capital structure change, because in order to buy the target company, if you are using your own money, right, own money, then you may not go for larger debt capital. So your capital structure may not change significantly. But the problem is, you know that we discussed your cost of debt at the moment of your company is high or low. Cost of debt of your company is high, exactly. But do you think that you need to do some risk management to reduce your cost of debt? Yes, very much, very much. So you need to understand in your unseen, they might give you further information for you to think possibility. You may be able to restructure your debt at a lower rate because your 19% rate at the today's context is very high. You don't need to pay to 19% to the bank. So you should be able to reduce it. WAC 17.5. I don't know from where do you get 17.5. I think there are many people that confirm it's 15.3. Please double check your number. Okay, so we have to understand your cost of equity is 16.5, cost of debt is 19.5. That is before tax. Before tax. When you calculate WACC, are we going to take before tax or after tax? Always WAC when you calculate, two things to be remembered. One is after tax and the other thing is market value. So when you take your cost of debt 19.5, it's high at the moment, but definitely after restructuring, you might do some restructuring because it's otherwise unnecessarily you're paying bank. So when you do the restructuring, your cost of debt will come down. So your next year WACC might come down. WACC might come down. So when the WACC comes down, use that WACC, that revised WACC, to discount your future cash flows. At this moment, we can't do the calculation of valuation because you have only 5 years of information. But definitely, these are two target company businesses are infinite business. So your 5 years, after 5 years, they will tell you what is your cash flow growth. So you have to calculate your free cash flows after 5 years also and discount at your revised WACC. And what is your market value you get? When you use your WACC and discount your free cash flow firm, you get your market value. That market value will be what market value? After discount, yeah, firm market value. When I say firm, very good. Cost of equity plus, sorry, debt plus equity. From the market value of debt plus equity, what we do? In order to get the market value of equity, what we have to do? We have to take cost of debt after tax. I think I repeatedly said WACC when you compute, there are two things to be remembered. Please make a note of those. Cost of debt has to be after tax, market value of the debt or the market value of equity plus debt has to be taken. So when you get the market value of equity plus debt from the free cash flow valuation minus the market value of debt, you generally don't, it's a book value of debt. So you deduct your book value of debt, then you get your cost market value of equity. That market value equity you compare with your net asset value, what is given in your pre-scene. So your pre-scene net asset value of the hotel company 12 billion. Tax rate given will be given in your unseen material. If you have properly gone through your past papers, you would know that tax rate is generally given in your unseen material, not at the pre-seen material. Okay, but in Sri Lanka, all of you all know today what is the tax rate in Sri Lanka? Corporate tax is how much? 30%. Exactly. Right? 36%. Which country? right? So 30% is the rate in Sri Lanka. Now any sector you take is 30%. So you don't have to worry much. But then anyway, unseen material, you will be given the rate. So don't worry about it. Otherwise, we have to use the effective tax rate based on the PNL. But we don't have to too much worry about it. 30% tax you can consider. Unseen material, if they change it, you take the unseen material tax rate. Okay. So this is basically valuation thing. What I was asking is, when I get your free cash flow based valuation, what is your market value you're going to get? You compare with your net assets value. Generally, what value should be higher? Not the free cash flow. I am talking value. Net asset basis will be higher. Okay. Any others? When you value the company, any company, going concern company, when you value using cash flow method, the market value what you get, will it be more than net assets or less than net assets? I think those who are making mistake in this understanding, please watch the valuation chapter. Wherever you have followed your classes, that's okay. But even Sri Lanka, I have done a summary version of the valuation chapter. It's in the YouTube. Please watch that and you will understand that. And when you look at my past paper discussion with CS Sri Lanka, you would understand that always we say that any company valuation, if it's a proper company, your net asset basis valuation will be always lower than the cash flow based valuation. Okay, please understand that. Unless the company has not been managed properly, then your net asset value may be more than your cash flow basis. And net asset value is the minimum guarantee value. It's a lower value. Please understand that. Net asset is a minimum guarantee value, but it's lower value than the cash flow based valuation. Unless your company is not managed properly. Simple as that. Okay, please understand that. So we have now finalized your target company valuation. Now can we go back to our company? Our company is the what you call the listed company, Quick Eats PLC. Can I have Quick Eats PLC value one by one? Shall we start with the net assets value of the Quick Eats PLC? If anyone is targeting to buy Quick Eats PLC, how much he has to pay under net assets basis? Can everyone answer that? If anyone is going to buy the Quick Eats PLC, now if I want to buy the shares of the Quick Eats PLC in the market at the market price, right? How much I will be paying? 9.6 billion. When I pay 9.6 billion, assuming that market price you can buy the company 9.6 billion, am I going to get the Quick Eats PLC only or Quick Eats PLC and two subsidiary companies? Yeah, very good. I think there are very many people are very clear. When you buy at 32 rupees per share, 300 million shares, you don't buy only Quick Eats PLC. You buy the group. 100% you get it. Very good. That you are clear. So 9.6 is the market value of the company to buy. But the market value you will go up because you have to buy the controlling interest. You have to pay more. But based on the market price today, it's 9.6. But if anyone is going to buy controlling interest, please make a note. He can't buy at 9.6. He has to pay more than 9.6. That is one. Now, what I asked the question not about market value. I asked the question about net assets value. How much is the amount of net assets based this company value? Company value is 10.2. But if anyone is going to buy the Quick Kids PLC based on net asset basis, how much you have to pay? 11.2 billion. Why? Now you understood. Now, if you are going for a market value, you say entire market value, that go entire group. So when you are going on net assets, when you are going to compare with the market value, please compare with not 10.2, 11.2, 11.2. So 11.2 is the net asset based valuation. Okay, that is a, so you have got value of under 1, net asset base 11.2, market value 9.6. Can we try the PE method of valuation? PE method of valuation, how do you value the company? Can we write the formula? PE method of valuation. PE method of valuation, this group, if anyone is valuing this PE method of valuation, how do you calculate the value? Market value equals to EPS into PE ratio. EPS into PE ratio, you get what? 10.38. No. Market value. Somebody found it. Market value per share. When you multiply price earning ratio by the earning per share, you get the market value per share. If you want to calculate a total market value, how do you calculate? What is the formula? There are two formulas. One is for per share, one is for total market value. Total market value is what? Market price in number of shares. Come on. I think. Yeah, somebody got it. Profit after tax multiplied by P/E ratio. Profit after tax into P/E ratio. Can we calculate the market value of the group? Profit after tax multiplied by P/E ratio. Profit after tax is how much? Group profit after tax how much? Group profit after tax how much? 1144. Very good. P ratio is how much? Industry P ratio. We don't value based on the company P. Company P will be company P. We use the industry P. When you're going to buy, that you will use the industry P. Multiply the earning market value by calculating the P ratio 9.2. Multiply that with the profit after tax of the group. That is 1114. How much is the market value? How much is the market value? 10.52. Okay. Now you have got three values. What are values? Net asset base is 11 point something. P earning based valuation 10.5. Net asset base is how much? Net asset base is 11.2. Now tell me, your market value is higher than net assets or lower than net assets? Ideally, a company market value should be more than the net assets or less than net assets. Ideally, your market value of the company should be more than net assets or less than net assets. Very good. I think we are very clear now. So this company is at the moment undervalued. This company undervalued. Why? Why it's undervalued? Already we have analyzed the case. Why the company undervalued? Low debt? No. Risk of accruing? What is that? Come on, we discussed about these ratios, all calculated, done. Net value 11,000, book market value 10.5. What is 10.5? Market value 10.5. Market value is how much? How much market value we calculated already? 9.6. So your market value 9.6, net value 11.2. What I'm asking is, Now, net assets should be more or market value should be more? Market value should be more. Please understand that first. Market value should be more than net assets. That is the cardinal principle if the company managed properly. Company is managed properly. If the company not managed properly, your net asset is always more than. If you say, for example, you are your company is a renting out building, renting out company. You bought a building. You bought a building. You have a building, 1 billion worth of building. You have bought it. You have not rented out to anybody. You are not rented out to anybody. So you bought a building to rent out and you are not rented out for 1 year. So what is your income? No, what is your income? I'm asking a question. What is the income? You are building higher current ratio. Some people are answering different answer. Maybe the you are listening my voice later. Zero, exactly. Your income is zero. So if your income is zero, your asset basis, net asset basis, you will have value. But if you are not earning anything, shareholders are getting a return or no return. No return. If shareholders are no return, shareholder wealth or shareholder satisfied and the share price goes up or comes down. Comes down, exactly. So that is the same thing in this company. In this company, we already analyzed the case on the profitability side and we found, are you generating sufficient return or not generating sufficient return? No, exactly. So you have excess assets which are not generating sufficient return. You have to find new investment opportunity and earn. Since you are not generating sufficient return, your market price is lower. Why? You are not generating sufficient return for shareholders. They are not happy about your company. So the value is lower than what you are expecting. ROC is probably lower than industry average. No, those are additional information we are talking about. That's what now you don't lose focus. Your focus has to be first understand your company. We don't have to worry about other companies. Your company is not generating sufficient return. How much your ROC is 6%. How much your return expectation? Shareholder wants 16.5%. And debt holder wants 19%. And you are earning only 6%. So is it sufficient? Not sufficient. So of course your market value will come down. So your share price is undervalued or low value. Undervalued, exactly. You're already share is undervalued. So how do I correct it? How do I correct this? How can I make my company to make more share price? I have more share price. Lower cost of debt. By reducing the cost of debt, your market value goes up. Before that, what is your main problem? After so discussion, you can find that. Dividend policy. Exactly. I think there are few people understood. Your present problem is your profitability is not enough. Why? Because you have excess money not generating sufficient return. So first of all, identify that excess money and convert that excess money to earn more return. So that is your problem. Please understand this case is talking about excess money not being invested properly and earn return. So you have to find the ways to earn more return, right? Reducing finance cost definitely has to happen because you have a higher finance cost. That will happen. But it's not your first problem. Your first problem is your excess money sitting on excess money. You are not generating sufficient return. So please use your short-term enough assets you have, financial assets, invest for long-term to increase your return. When you don't earn sufficient return, you create value or destroy value. Exactly. So at the moment, your company economic value added is a plus or minus. Very good. How do you calculate economic value added? Can anyone write it? How do you calculate economic profit or economic value added? How do you calculate? Economic value added is net operating profit after tax minus cost of capital. No. Anyone? Operating profit after tax. No profit after tax. Yeah. I think there is a not net operating profit. Net operating profit after tax, not the, sorry, I think the previously was the same thing. Net operating profit after tax minus capital employed into WACC, right? Capital employed into WACC. You deduct it from net operating profit after tax. So that's your economic value added. This company will have positive economic value added, minus economic value added. Without calculating, you should be able to answer by now. Minus, very good. So will you create value or destroy value? Yeah. Okay. So you are very clear about it. So this is basically we have valued the present company, three bases: market value, net assets, earning basis, and we have understood the reasons for your undervaluation in the market. So we know what to do with it. We have to invest the money long term, and we should buy one of the companies that we are talking about after doing the valuation properly. And we know what the synergy it can create. So we have gone through those to understand this. And we need to be very clear here. This area of this company is talking about, even though it's a group they are talking about, it's not a group we are very much worried about. It's because the company is the major one. Major one is the company. So we should be able to make use of the excess money that the company has and invest it for long term and start earning more return. And as they mentioned, the two acquisition company we can invest and create more value. When you do that, if we need more money to buy the company, target company, should we take shareholders' money or debt holders' money? Can you answer that? If they sort out the excess money by investing in the long-term investment, when they need further money to buy the target company, should they use the if company shares are undervalued and have cash surplus, there is a risk of takeover. True, true. That is all theory. Please understand. In order to take over, who has to sell? These are theory, but you have to apply it properly. In order to take over target company, both funds, depends on capital structure. No, my question is, if someone is wanting to buy the target, your company, they want to buy because they understand it's an undervalued company and you have enough cash. It's always attractive for anybody to buy. Who has to sell? Who are the owners? Yeah, shareholders. Who are the owners? Brothers are the key owners. Who owns how much percentage? Very good. So can you buy 65% even though it's attractive from outside point of view? Can you buy the target company easily? Can anyone buy this? No way. Brothers are not going to sell the 65%. Maybe if at all you can buy 35%. So please understand these things and write. The other will be writing a wrong answer. Your theory is correct. Attractive for anybody to buy, yes. Who is going to sell? 35% people will sell, but 65% will not sell. That is their own company. Yeah, only 35 you can buy. That you can't do anything. 65% is a controlling stake. Okay, so you have that knowledge. So this is basically the things, the case, right? Now, When I look at it, what are areas for possible question? I think there is a question here. Return on long-term asset is also lower than what the investor require. Isn't it there another problem? No, no, no. Please understand, your long-term investment debenture or the bond only 9%. Is it the only investment opportunity? So where do you invest your money? Where do you invest our money? Return on fixed assets? What is fixed assets? No, no, no. Please understand, or if you have excess money, you don't invest in treasury bond and their bank deposit. Shareholders gave you money to invest where? Please understand that question. Shareholders gave the money to company to invest where? Your business. Your business. So it has to be projects, new investment, new acquisition, business opportunity, expansion. Those are things. No shareholder gives the company money to invest in the bank deposit and treasury bill and treasury bond. Why? If that can be done by the shareholder themselves, why they should give it to the company? So please understand, the money needs to be invested in the business. No shareholder wants the money to be invested in the bank deposit. While you're managing your business, you will invest some money in your bank deposit, treasury bill, bonds. That can be done. But you don't run a business, you take the shareholder money and invest in treasury bill and bonds. No, that is not shareholder wants. That is themselves, they can do it. Okay. So we have got the idea here. The company needs to invest the money in the long term. It's a business investment. So to get more return, that's the main issue. What is WCM? What is WCM? I don't know. We didn't talk about WCM. Okay. So now return can be increased, can focus on gearing as well as increase value because company are borrowing capacity. I think you all been listening what I've been telling. Firstly, what problem to be sorted out in this company? Yeah, earning. In order to get more earning, you have to invest the money long term in a business and start earning more. That is first step. Second, you can reduce your finance cost. If you think it's a more finance cost, you can reduce it. So that is the thing. After that, if you found a new opportunity of business which can give you a better return, please borrow more, increase your capacity. Your capital structure you can change. That's no problem. But that is not your first task. Don't go and borrow money and invest until you find a good investment opportunity. Okay. Somebody say proper management. Don't say the proper management is a problem. It's actually they are not investing their long-term money. I think there is one other area. This company shareholder wealth has been reduced. We are not told or we are not given information in the case whether this company pay dividend or not. Are they paying dividends? No information given in the question up to now, pre-seen, whether the company pay dividend regularly. So when you don't pay regularly dividends, shareholder wealth increases or reduces? Exactly. So please note, under dividend policies or dividend theories, you would have learned dividend and share price at what relationship? Positive. Very good. So please note that this company, based on the pre-seen at the moment, the company has not been paying dividends. Right? There's no information to say not to pay, no, not paying or paying. So we believe that they are not paying. So if they are not paying, the shareholder wealth comes down because there is a negative impact. So the company needs to find the ways to pay dividend to shareholders. They have excess money also. Excess money also. As a shareholder, are you happy with this company performance? How much you are expecting return from this company? If you have money with you, how much you can earn at this moment? 16.5? No. If you have if the company give you the money back, 6%. Now see how many answers. 6, 11, 15.3, WACC. If you are the shareholder, if you have the money with you, how much you can earn? You will have a basic return of your government bonds give you 11%, right? That's basically a return you might get. So 11% is possibility. So if you are going to get 11% on your own, do you want this company to earn 6% for you? No way, no way. So please get this. I'm just giving thoughts to you so that you can understand what I'm trying to say. 11% if you can earn, no point in this company earning 6%. So the company needs to find the ways to earn more return. Okay. Right. Now we come to the final level of discussion. What are areas this question can be asked? What are the areas? Valuation. Yes, definitely valuation of two companies, target company. Then merger. Yeah, that merger and acquisition is basically the valuation area also, right? Valuation only you'll be doing in merger acquisition. Swap, exactly. As I mentioned, the interest rate risk can be there. So they can talk about swap. Then, yeah, you can be asking about the strategies what the company can take and all the stuff. Investment appraisal, I'm not too sure investment appraisal or what can be done. Working capital issues, actually working capital excess money. So they can talk about excess money, but then I don't think what can be asked on that. Dividend policy, of course, they can ask on dividend policy area. Then please note your capital structure, will it change or will not change? Or possibly it will change or not? No change, will change. If you are going to invest in a target company and you need more money, and that company returns are going to be kind of attractive, will you borrow money and invest? If the new project or new investment, new hotel investment, if the returns are better than cost of debt or whatever, will you borrow money and invest? Definitely. So please note, if the company has not paid dividends in the past, please listen. If the company has not paid dividends in the past, first thing, before you investing long term, see what kind of dividend policy you should carry on as a company, because it's a listed company. It's a private company, you can wait without paying any dividend. But a listed company, you have to pay dividend because there's an expectation by the shareholders. So since you have excess money, and if you have not paid dividend, please, first thing you have to suggest, company should come out with a dividend policy for a long period and pay dividend accordingly. One. Second, you go and invest in a long-term investment. So by paying dividend to shareholders, they will be happy. Share price also will increase. That means undervaluation will change. Then the long-term investment, when you make, definitely it will get more returns. That also will benefit. When you go to invest long-term, you may need money. Then you might look at option of borrowing money. Then your capital structure will change. So the one of the area they can ask, the new WACC calculation and the new capital structure, if they are going to restructure your debt. Restructure your debt, and then you restructure your cost of debt. In that case, you will have a new WACC, new capital structure. So that's another area. Then probably the examiner could ask the benefits of APV approach, adjusted present value, when the last paper talked about it. So the APV approach also they can be just touching upon to find out what's the benefit of using APV approach, because last December paper also asked that question. So they can talk about it because your capital structure is going to change or cost of debt is going to change. So there is the impact you can look at. What is the impact of the change? You can find out. Yeah, solution to improve the company, definitely they can ask, right? Whatever we are discussing the analysis, you can talk about it. So I have talked about valuation, mergers acquisition area, capital structure, interest rate risk management, that's a sub transaction, and working capital management. You can be asked various strategies to be looked at, and what somebody mentioned, qualitative stuff. What could be the reason for net profit margins being quite attractive? Please understand, net profit margin, how do you calculate? Net profit margin is higher, but ROC is lower. Net profit margin, what is your base? How do you calculate? ROC, how do you calculate? ROC is a return you calculate on your investments. That is your shareholder money and debt holder money. Net profit margin, how do you calculate? The profit margin you keep on your sales. On your sales, what's the margin you are getting? Of course, you are getting a margin on your sales. But from your money invested point of view, your money is not actually properly used. You have excess money. You have taken the money from debt holder and share. It's like you are borrowing. Now I'll put this way. At what rate you borrowed money from bank? At what rate roughly? Average? Very good. 20%. You borrowed at 20%. And what is the return you are generating? And balance, where is your money? Your money is in short-term financial assets earning lower return. And your cost of debt is 20%. Are you generating return to pay even your bank interest? Are you generating at least your bank interest? No. So that means you are actually not managing your money properly. Your fund management is very weak. Your treasury management is very weak. Okay. So please need to understand this whole thing when you are looking at your question, because examiner can ask different questions. So you should be able to grasp all this and answer. So what else the area? I think almost all the area we are talking: valuation, mergers, interest rate risk management, working capital management. Okay, and then we are talking about capital structure area and APV, dividend policy. All these areas could be tested. Okay, so I believe generally question now, it's for the overall guidance. There are 3 questions in your paper. Question 1, 2, 3. 3 is the 50 marks. That's a case study pre-scene we are discussing. Question 1 and 2 are 25 marks each. Try much as possible to score from question 1 and 2. Because generally the examiner gives those 2 questions to students for them to score marks. Right? So try much as possible to score marks on the first 2 questions. Out of 25, at least you get 15 marks. Then you are talking about 30 marks from your 50 marks. Then the balance 50 marks, you have to get only 20. Because balance 50 marks, getting 20, 30 marks is not easy. Because there are a lot of things to be remembered, a lot of things to be understood. You need to be able to do the answer faster. So there are a lot of challenges you face in the question 3 compared to question 1 and 2. Because question 1 and 2 definitely has 5 parts. 5 parts. So you get marks on each part. So generally the parts will be able to score some marks. So everyone can get some marks on the question 1 and 2 rather than question 3. I'm not saying that you should do question 1 and 2 for 2.5 hours and try the question 3. No. 1.5 hours for first 1 and 2 questions. Balance 1.5 hour for 1 and 2. Actually, you will be the pre-scene, not your all the calculations you can take it. No. Right? That's not there. So you need to be understanding your case. Now you have enough time. You are not given the, somebody mentioned, no, you can't take the thing. So you are analyze. That's why you are given 3 weeks, 4 weeks time to analyze the case to understand it properly. Now we have done it once. You can watch the video again and you may do it to your friends. You can do it to your friends and you can understand better. So if there are any questions on any of the understanding, you can discuss with your friends. And still, if you want to find out some more understanding, please contact me, because maybe you can message me. Maybe after office hours, I can help you. Right? Uh, my mobile number, not 772-857-326, not 772-857-326. Right? So you can message me and ask question. So there's another, it's a WhatsApp number is not 76-854-9032. WhatsApp number, not 76-854-9032. So please message. So if there are anything where I can help you, definitely I'll help you, because you have 3 weeks more. So you can get more support, and then make sure that you are getting prepared properly. Be confident, work hard, not 772-857-326, not 352. The second one is fine. That WhatsApp number is correct. Not 76-854-9032. The first one is not 772-857-326. Okay, so please make a note. So till the exam time, anything where you want a clarification, because I'm also working in a company, so please message me. Maybe after office hours, I can definitely. Yeah, you are right. Not 772-857-326. So I believe that a lot of things you have gathered by any prediction. I think that's what we predicted. Like these are the areas to be tested. First and two question, of course, now you should know the area which are probably can't be tested, or not that can't be tested. We have talked about what are possible things on the question 3, areas to be tested or area could be tested. So then question 1 and 2, you are left with what are other areas you should be knowing by now. Investment appraisal, foreign currency management, right? So investment appraisal, foreign currency management. What else? Maybe the examiner may not touch the capital structure on the question 3. He will touch on the question 1 and 2, capital structure area. Working capital could be, yeah, working capital. Any possibility hedging? Hedging is what? Risk management. That is the interest rate risk management and the foreign currency risk management. Yeah, investment. Very good. Bond valuation, portfolio management. These are question 1 and 2 possibilities. So it's basically, I'm only saying that these are other topics you have. So anyway, in CA, we don't have any, right? All the questions to be answered. So you should master almost all the topics. Don't excuse yourself by not looking at any question. Portfolio management, yes. But please, I know there are many people, many students, even though your lecturers would have told, you all generally don't try all the or recent papers. At least try the 10 papers. At least try 10 papers to get prepared yourself. Because that is must. Because then you are very much clear the trend of the papers and some of the things which are common similarities you would observe in the papers. So please do 10 papers at least, because all the lectures would have covered, or it's there. I have done for CA Sri Lanka, thanks to CA Sri Lanka. There are, I think, almost 7 papers, question and answers, pre-scene discussion, are then CA Sri Lanka YouTube channel. So please watch that. Please watch that. If you don't have any other notes or video, you can watch that. So definitely it will help you, because that basically covers the almost 7 papers. So other 3 papers, if you have followed any classes, you would have been covered on that. Okay. So all the very best. So any questions, if you want to clarify, I can clarify for a few minutes. Work hard, do more exercise, that more questions on your own. There are people who would look at the answer and think that I understand the answer. No, you do your own. You do your question. You practice the question. Time management is important. I'm sure that all the papers in the other papers, previous stages, you would have done it. But this is final level, right? We are talking about almost 1,000 people doing exams. So you should know that it's very competitive exam. It's not about whether you have the knowledge or not. You must be definitely having the knowledge. You have gone through once or twice, 3 times you would have done the papers, but your knowledge is not a question here, right? It's a competitive exam. So you have to be competing better than other person. So you should get prepared better. Don't waste time. From today onwards, you have another 3 weeks to go. So you can get prepared well and be confident. Be confident. Don't talk about negative what you went through last time. You failed a couple of times. That doesn't make any progress in your life, right? So please don't worry about what happened in the previous papers. You got 30 marks, 20 marks. Those are not relevant. Be confident and think it's a fresh paper. You're going to look at it. If it is a fresh paper, so be prepared. Get support from other people, your friends. Short-term finance listed less in previous exam. I think like, yeah, okay. That's why the working capital management can be listed. So better you get prepared for that also. So all the very best. Thank you very much for the opportunity given to Sri Lanka and the students all together. I'm sorry about the technical hiccup, right? So maybe there's an issue, but still we have managed to do the 2 hours. So all the very best students. So don't worry. Be confident. Any questions till your exam time, please be in touch so that I can support whatever I could. All the very best. Thank you.